All right. Good morning. Welcome back to the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. Glad to be back again with another. What are you doing?
I don't know.
With
Can you
another
see that
fun
too?
episode. Yeah. It's just like zoomed in and then zoomed back out. I need to get some more stuff on my walls. This house is still new, so we just have a couple of things on the wall, not a whole lot of stuff.
Hey, what state do you live in, by the way? I can't tell.
Uh,
Uh,
South Carolina. And so everyone knows where we operate in. But boy, so this week we're talking about when to walk away, and as the great Kenny Rogers would say, you got to know when to fold them and walk away. So this week we're talking about honest, transparent deals that either we participated in, we've led, or we've invested in, or we know other people that have talked to us about some deals that they should have let go, and we're just gonna kind of get into the honest side here of let's label it as this honest side of some regrets that we might have. I think, yeah, good.
No regrets.
No regrets. Yes, everyone has deals that have regrets. And hey, it just teaches us valuable lessons. Hey, good morning, Dennis. Teaches us valuable lessons. And learning lessons is a good thing because it makes you a smarter, better, wiser investor. The worst thing that you could do is make mistakes and then repeat those same mistakes. So this week, we're talking about some mistakes that we've made and, more importantly, what we've learned from them. So, Tim, take it away, Maestro.
What? Me? No.
Yeah.
Yeah. So I don't know, man. Like when I think back to some of the stuff we've done or deals that we sat and we started talking about and we were like, should we do this? It's like looking back on it, guys, like we have a number of deals in our portfolio. Most of our portfolio is doing just fine. Even considering, the liquidity and, cash flow strains that this market's putting on properties, we're doing okay. But, looking back on it, like Tim, like I think you would agree with me. Like when we look across our portfolio, the ones that are the toughest are the ones that you and I probably had the toughest conversations about as we were headed toward closing or even thinking about putting it under contract. Right. Like, and one of the things I read that I really like is like when you stop talking about the numbers of the deal and you start defending the deal, that's a red flag. Right.
Yeah. Because you fell in love with it.
Yeah. Yeah. And I mean, think about some of the conversations we had where we were like defending it, like where you're challenging me or I'm challenging you. And, and we're like, no, this is good. I promise, it's like, so looking back on it, it's like some of those things turn out to be red flags, right, guys?
Mm-hmm.
I don't want to call out anything specifically, but there's a deal that I'm in. Tim, you're not. I've talked to you about it though. And it's a smaller deal. And I remember specifically talking with, the guys that like reached out and asked me to do the deal with them and stuff. And very early on, I was like, I don't want to do this deal. Right. Like I was like, it's tight. I don't see the upside. I don't want to do this deal. And, they really, really defended it, if you will. They went after it. They were really, really passionate about it. And at the end of the day, they ultimately came in and they were like, hey, we want to bring you in to do this deal. You don't have to do anything other than help us run it, right? Bring some, operational experience to it, that kind of thing. So I was like, all right, fine. And here we are, 3 years later, and the deal's struggling. It's been struggling the whole time through. And looking back on it, guys, like that's one where I'm like, hey, even though I don't have any investors and my own investors in the deal, even though I don't have, quite frankly, any of my own cash in the deal, things like that. I look back at it and I'm like, that's one I really wish I hadn't done. It's just been a time suck. It takes a lot of time. It's not doing well. I didn't think it was going to do well at the beginning. And looking back on it, I'm like, why didn't I just walk away? And I think that's probably a good place to chat for a second is like, why don't we just walk away? When we see something that's probably not a good deal, why don't we just walk away? And in that, looking back on, yeah, go ahead, man.
It's got to be a lot of ego, right? I mean, I feel like when one of the sayings would be, I came this far. I didn't come this far to come this far, meaning I've spent money on the deal. We've done due diligence. Like, I can see a path towards success. This deal might have a little bit of hair on it, but I feel like we can make it work. Like if
Yeah.
this and this and this and this happen, it'll be a great deal, right? And it's like it's just too much. It's just too much speculation, right? And I feel like some people get down that path and are just like, I can't walk away from this. I've got too much invested in it at that point, and it feels like a failure. And that's anything but the truth.
Yeah, man. I think what you're kind of you're hitting on like the sunk cost fallacy, right? Like,
Sunk cost fallacy. Yeah.
And guys, like that is even in the corporate world, that used to be one of the biggest ones. Like I would sit in conference rooms with guys and like argue against that. They're like, but we've already spent this. And I'm like, so we're going to spend more to like just make a bigger mistake? Like, come on. Like,
I like when people say it's like when you're throwing good money at a bad deal or good money at a good deal, right?
Yeah.
In that situation, you're throwing good money at a bad situation or bad deal.
Yeah. And so I'll talk about something again, talking about personal stuff here. So I'll talk about another one that I'm not an operator on. I invested in because I trusted the operator at the time. And like here we are today, God, like 3.5, almost 4 years in, and it's not paying. It's not, it's been refied twice, 3 times. I can't remember exactly now. Just to create more reserves to keep the deal moving along. And I was, again, Tim knows the deal I'm talking about. I've talked to him about it a couple of times, and I've really challenged the operator on it and the ownership on it. And even last week, guys, I'll tell you, like you're talking about the sunk cost fallacy, you're talking about like knowing when to say when. Like I literally went to them, I guess about a week ago now, and was like, hey guys, if you're looking for permission from an investor, which I am, to just recapture what you can and move on, you got my permission, right? Like if you lose 50% of my money, that's okay. Like, because
it happens. Yeah.
It happens. And, and no, none of us want to lose, but at the end of the day, it's like you guys feel this obligation or something ego driven to not lose or be able to say you've never lost. But man, if it takes 10 years for you to be able to look at me and go, we didn't lose your money.
Well, you did. You lost me all the opportunity cost of what I could have done with it if you just realized it and moved on.
Yeah. And and Tim, that's a really good point, because it's exactly was my feedback. I'm like, guys, listen, like I'm not interested in 3, 5, 7, 10 years to get me back to even. Let's just cut it. Give me back what I can get now, because I think I can do better. I think I can get back to even sooner than you can by staying in this deal. Right.
Yeah.
Like,
right.
And guys, I always think that's like a big piece of it. Like not only knowing when to walk away before you buy something, but knowing when to walk away after you bought something. And I'm not talking about just turning in the keys and giving up and throwing your hands in the air. That's not what I'm talking about.
No.
I'm talking about like getting in there, digging in, trying to recapture something, and then saying, hey guys, I was able to save this. Right. And Tim, you and I did a deal with a guy that we know out of South Carolina, small little deal in Columbia. And he was in that position. He was in a position where, I mean, they were so close to giving the keys back, having no choice but to give the keys back. He dug in, he traveled there, he dug in, took care of it, and he didn't recapture everything, but he got something back for his investors. And his investors were like, thank you. Thank you. I see what you did. I know where it was. I know where you ended up. Thank you. And guys, sometimes that happens. And
that
sometimes
can be called a win, right?
Yeah. Yeah. And sometimes your investors will just see that and go, you know what? Didn't work out, but thank you. Thank you for not giving up. Right. And
yeah, that's the worst thing that you can do is just give up. Right. I mean, having the ego to say, hey, I didn't give up, but I also am willing to cut my losses and move on. Because now, like where we're at in the market cycle right now, now's the better point to be redeploying capital into what you believe is going to be the next 5 to 10 year run, right?
Yeah.
Now, is this the bottom? I don't know. I mean, maybe we got another 12 or 24 months of maybe sitting down here, or maybe it goes down a little bit further. But if you think about, how people invest into stocks, the dollar cost averaging and all that stuff. Well, I mean, now would be a good time to put some chips back on the table and look at buying assets that have been price adjusted from the increase in the changes in the expenses and income, right? Now, I do believe that over the next 12 months, maybe even 24 months, depending on where you're investing in, right? I mean, because some markets in the Carolinas are better than others, you might have a little bit of rent decrease still coming, or maybe flat for the next year or two. So maybe you want to try to price that in, or maybe you're willing to just extend your timeline and ride it out a little bit. But I don't think that we're going to see like a significant drop like we've seen that was ultimately caused by reappraisals of taxes and the readjustment or the catch up of insurance replacement costs, right?
Yeah.
For reference, replacement costs on an insurance policy in 2020 was like $75 a foot. Now it's like $150 to $175 a foot.
Yeah.
So that essentially just doubles or even triples your insurance cost, because the amount of coverage that your insurance company is on the hook for is significantly higher, right? Your replacement cost or total insured value, TIV, is significantly higher. Well, we've seen insurance costs kind of leveling out. We've seen taxes, go through their reassessment periods, and we're good for the next 5 to 7 years or so. Now it's kind of a good time to kind of buy something and let the rents either stay flat for a year or two, or start to slowly incline. And then as the equilibrium between supply and demand changes and flips, and the market economics continue to get better again, that's when you're going to end up doing better. And you're better off, just like, as you said, just, I can get back to zero faster than you can get me back to zero by just holding on to this asset, right?
Yeah. Yeah. And Tim, I think you're hitting on a really good point, because, listen, investor sentiment right now, guys, like if you've gone out there and you've raised capital or tries to raise capital right now, most of you are probably struggling. Tim and I look at each other all the time right now. And we're like, I'm not sure what I can do right now in terms of capital raising, but which is kind of strange, because if you just listen to what Vitaly was talking about, this is the time to be buying. This is literally the time to be investing and buying. And guys, I'm not trying to tee anybody up for a capital raise. We don't have anything.
We don't even have anything in contract.
We don't have anything under contract that we're getting ready to launch.
And to be fair, the deals, the things that we are buying are small enough where you and I can just split it, or we'll bring in maybe one other person or two other people and do a very small JV deal. We're not doing those larger deals right now, simply because we don't know if we can raise the money. But we know that, we can call a couple people and scrounge up some cash to buy a really good small deal.
So if you hear kind of what we're saying is like, we've taken the pulse of the investor market, and they seem real shy right now, or gun shy, right? But Vitaly and I are like, yeah, hell yeah, man, I'll put my own money into a ton of stuff right now, because right now is a good time to be buying. Like if you look at the people who are gun shy, and I can be one of them too. If I look back at some of the LP investments I did, if you look at the people who are gun shy, it's people who got burned at the top of the market. They entered deals at the top of the market, and now all these factors that have settled in and caused this downslope over the last few years just have all these people going, that did not go well, I'm done. Which is really, got to be honest with you, the wrong idea. Because people that were buying like back in 08, 09, 10, and 11, and people were looking at them like they were crazy. Well, ask them how they felt in 15, 16, 17, 20, right? And they're like, hell yeah, I'm glad I did that when people called me crazy. And,
when it was scary and nobody else was doing it.
Yeah, and this is a really good time to be doing some of that right now. And I know we're getting kind of like off our topic here a little bit, but it's when to walk away and when not to walk away. Right. Same thing. I mean, they go to hand in hand. And, looking back over the last few years, there's absolutely a few things should have walked away from, like that LP investment I'm telling you about, where I challenged the operator. Like looking back on it, I'm like, you know what? Looking back, there were a couple of red flags there. There were a couple of red flags. I admit it, guys. I got caught up in the hype of standing there with the guy, and he's like, we're giving everybody their money back in 6 months, right? And it's like, 6 months. Well, hell, I just looked for it back in like 2 years. So if he's saying 6 months to 2 years, that's pretty good, right?
Yeah.
Well, guys,
we got a really good question here from Brian Kovaleski.
What's he
says,
say?
I've heard you say several times recently that you need or require a 7% return to make a deal work now. Have you lowered the minimum return you're looking for, or where does that 7% number come from? So that's a really great question.
Good question.
It's a combination of all of what you just said, right? There has been a reset of investor expectations, and there also has been a reset of what my buying criteria has been. And a lot of the deals that have been difficult are the ones that had significant value add, where it was like, okay, once you get through half of the rent roll, you're on your short-term bridge loan, you'll be breaking even or pretty close to breaking even. And then from that point forward, the rent roll will continue to increase and it'll pay its own debt service. So you're like, okay, well, let me just raise an additional capital that covers my negative cash flow period. We'll work hard on this deal. We'll turn the rent roll over very quickly. We'll send out the renewals as fast as we can and work through the rent roll, strategically evicting people and doing whatever we need to in order to get the rent roll up. That produces a lot of returns for the equity value upside on the back end, right? So you got a lot of equity tied up into a deal that it generally can be hard to convert that equity to cash. So what I've done now is we've started to look at more, I would say they still have some level of a value add, but they're not hey, we're going to buy it with a short-term bridge loan and try to rip the Band-Aid off and go after these massive rent increases in year 1 into year 2 and hit our refinance target by 18 to 24 months. So the way that we've been looking at deals now is that within the first 6 months, one, the property needs to be paying for itself basically day one, right? You need to have a minimum debt coverage ratio of 1 to 1.1 day one, right? With the in-place rent roll from the seller and what you expect your expenses to be day one has to be a 1 debt coverage ratio or better, right? And then by month 6 to 10, you want to start to being able to realize a 7% cash on cash return for your investors. And we're also looking at how we're operating our deals now. Instead of buying them with short-term bridge debt, we're looking at acquiring them with more so like 5-year loans. And instead of doing a one-time $300 rent increase, we might walk that resident up $150 year 1, and then $75 year 2, and then another $100 in year 3 to catch up to market. Because the biggest way to lose money is through the bottom line. And what does that mean? You losing all your money to vacancy costs, turn costs, and marketing fees, releasing commissions. I mean, there's a lot that goes into paying for a new resident at a multifamily apartment complex, right? Much like a business owner would look at their current client pool and say it is more expensive to acquire a new client than it is to upsell an existing one, right? So what you're trying to do there is apply the same principle of upsell an existing client and keep them in place with minimal renovations. And now we do offer like, hey, you can go up to 300, we can bring you up to market rate rent now, and we'll give you a new appliance package, right? That saves you a ton of money. Or we can give you, 50 or 60% of the increase year 1, and we'll paint your unit with, but you got to get all your stuff off the walls, but we'll come in and paint your unit while you live there, right? Or replace the countertops, or, do some bathroom work or whatever that is, right? But because you're buying now with 5-year debt, you don't have this refinance event at the end of year 2 with this massive equity, this forced appreciation equity position that you'd be in, right? So your IRRs are going to be lower by nature because of the type of debt that you use. So the idea is that back, when we were buying with bridge loans, you're looking at 18 to 20% IRRs plus, right? Because you expect to force depreciation, do a refinance, pull out equity, that all drives your IRR up. But if you have the expectation of, hey, I'm going to buy this and manage it over a 5-year period and make consistent distributions on the preferred returns, or if there's no preferred return, you're splitting the cash flow, pro rata equity share, right? The expectation is the IRR will be naturally lower because you're receiving more of your money on the back end of the deal instead of the front end of the deal through a refinance. So yes, the pitch is different now. Like, we're not shooting for those 18 to 20% IRRs. We're looking for a consistent 14, 15% IRR. And instead of pitching IRRs and massive, appreciation and turnover and forced appreciation and a big refinance and getting all your money back, like that worked all well and good when rates were really low and the market was really hot. But right now, the best thing that you can do is buy with 5-year stabilized debt, make sure that the property pays its debt, and then continue to pay your investors consecutively every single quarter for the next 5 years. And then 5 years down the road, when you go to look at an exit or you do a refinance and pull out everyone's money, then that's when everything gets really exciting because there's so much equity there on the backside, right? So being patient results in a lower IRR, and having a different understanding of what you're underwriting to and why is how you're going to portray that to your investors, and why we're still going to be able to raise money, right? We might not be able to raise as much money because there's a smaller investor pool, but I can guarantee you that the people that have invested with me in the past and that know that we operate our deals well and that we're transparent and we do what we say we're going to do, I guarantee you that those people are going to be like, you know what? Yeah, let's go for some more consistent cash flow for the next 5 years. And then maybe when the market's hot again, we can start looking at some of those crazy IRR value add deals.
Yeah, man, really good points, Tim. And I think there's a number of things in there, right, that you said that kind of like go into this, right? Like what you're talking about, like, you're talking about the investor pool and stuff like that. Like, what this really comes down to is, I think what a lot of investors did not realize, right, when they were chasing those higher IRRs is I'm not sure investors really understood what their risk profile was, right? Like, because at the end of right. Like at the end of the day, they're like, oh, I really like this 20, 25% IRR, but they didn't necessarily realize, and maybe operators weren't doing a very good job of like disclosing or telling them or being more clear about the risk involved with like a heavy value add that's producing that kind of IRR. But as they got into it, the investors were like, I don't like this. This isn't comfortable. This isn't going the way I thought it would. I really regret doing this. Well, that's because you chase this higher IRR, which inherently typically comes with a higher risk profile. And at the end of the day, it's like, no, what you really wanted was that more steady cash flow, which comes with like the 14% IRR. So, your risk profile is different than what you really thought it was. Right. And I think that's kind of like something you got to start talking to folks about these days is like, hey, everybody likes the sexy, 2x over 2 years, 3 years kind of thing. But at the end of the day, boy, people really, really want to see a consistent return on their investment. Right.
Yeah. That's more paramount than anything is getting those consistent distributions that they pay the bills ultimately. Right. I mean, if I wanted to do equity investments, maybe I'll just throw money in the stock market. Right. I mean, the equivalent is people that invest in the stock market for dividend stocks want the cash flow from the dividends. And that's ultimately what we're going to try to start providing more so in the future is, we're not pitching those high IRRs. We're not pitching, these ridiculous refinances. We're not pitching, because we don't know what's going to happen. But what I can tell you today is based on the in-place rent roll and what my monthly mortgage payment is, what the cash flow is going to be. Like it's very factual. It is very, I guess at the end of the day, it's very factual, right? And it's calculated of, hey, this is what exactly is going to happen in terms of cash flow. Now, cap rates could compress, expenses could change, rents could change, like everything can go against you in still that same scenario. But the underlying principle of when I bought the property versus what my actual debt service is, this is what my expectations are. And then any deviations from that should be able to tie back to exactly the difference between what your actual costs are and why they're different from your underwriting.
Yeah, because Tim, looking back on it, and Tim's been kind of privy to a conversation I've been having back and forth with an investor who's very frustrated about distributions, and one of the things that we're seeing is, hey, I expected to be able to return this amount of capital to you or some amount of capital to you in year 2 or 3, right? And what we're seeing is the value's there. The value's been created, but it's locked up, right? The lending environment has changed and they won't let us touch it. Where we thought we could get 70% LTV, we're getting 58% LTV. And
we just closed a loan on Friday at 55% LTV.
Yeah. And that 10, 12, 15% nugget, that delta, right? Well, that's between 70 and say 55. Well, there's that cash that we thought we were going to be able to give back to investors. It doesn't not exist. It's just locked up. Right. And that's, that's what Tim's talking about. He's like, hey, I projected something that was pretty common at the time. In fact, I was conservative at that time. I was thinking 70. They were giving 80. I
right.
thought 70. And here we are, we're at 55. I can't control that. Like,
No,
I
would have
have no
never, I would have never
No.
in my wildest dreams would I have underwritten to a 55% takeout. Right.
Right.
And it's funny, I literally just got off the phone with another lending broker for some other deals that we're looking at. And I pulled up my underwriting file and I was bang on the number, right, on the debt. So we bought these places almost 24 months ago now, coming up on 24 months later this year. And I underwrote to 70% LTV and a 5% interest rate. And rate, it depend. If I was going to go with a Fannie takeout, it was 5.7. If I was going with Freddie, it was 5.9. And they actually went up to 75% LTV. But I underwrote to 70 because I was like, I'd rather be a little bit more on the conservative side there. So, the underwriting standards and rules of thumbs and all that kind of stuff, they're definitely true and they're applicable. And it's, proofs right there. Like, it works. Now, maybe the cap rate changed versus what my, in the cash flow is different than what I projected. And, now it's very easy to back into like, why are we not getting the proceeds I expected? Oh, well, this is clearly what the problem, why, right? And one of the things that I also didn't predict was, as of January 1st, Fannie and Freddie are no longer giving credit for voucher overhangs on LIHTC properties, which was a huge part of our business plan. And now we're not getting any credit for that increased cash flow and those valuations by the agency lenders, which is also hurting our ability to refinance, right? So like, that's why our LTVs are lower. It's because they're underwriting to lower net rental income than what we had predicted we would be at.
Yeah. And, guys, like, we're being honest, right? You're transparent. So just one more, Tim, another example that's going to impact lending, right? Guys, I think you guys all know we had a fire at a property, right? So geez. We had a fire, we had a claim. Beautiful thing is the claim, helped us rebuild the property. So we have basically virtually a brand new property now. So that's great. But guess what? Like, our insurance just went up. How much?
We don't have a final quote yet, but we were paying about $450 a unit, $425 a unit on that one. Yep. And the estimated now is like $1,250, somewhere between $50,000 and $60,000 insurance renewal.
So guys, literally something we had no control over, right? Like, literally we do everything that we're supposed to do to make sure our tenants are doing what they're supposed to do, but sometimes they don't, right? And this one resulted in a fire, serious damage, big claim on the property. And because of that big claim, our insurance is going to triple, basically. It's going to triple. And guess what that's going to do right about the time we need to refi it? That's going to reduce
the value.
It's going to crush the value, right?
Yeah. So the advice from the lending broker was that, hey guys, let's refinance into something that's got really high leverage, but the rate's not going to be that good, just so we can make sure we can take out your primary lender. But then let's look at a refi another 2 or 3 years, because really what the lenders and the insurance companies are going to want to see is they're going to want to see that insurance policy earn out a bit. And as you go year after year after year with no claim, the risk from the insurance company's perspective continues to go down. So it will double or triple on this renewal, right? Or this new policy. But at the end of the day, every year we do expect a decrease in our insurance premiums, because we're proving that it's not as high as a risk, that was previously perceived.
Yeah, Christina, this is a place about an hour north of Charlotte, North Carolina. But guys,
I mean, that just happened yesterday. I just found that out yesterday. So it's like, oh gosh, like,
And guys, but that I mean, those are the kind of things that you run into. It's like, you have no control over that.
No, but I mean, it goes perfectly into like what we're talking about, was when to walk away. That is not a time to walk away, and there's no ego involved. It is, hey, this is a problem. We got to figure it out. Sorry, it's not to the expectations that we had considered it, but this is where the staying power matters, because somebody might be willing to just say, screw it, let's just sell it at a loss, or break even or whatever, because we can't get the debt, or because we can't do XYZ things. We're just going to get out of it and sell it. And that's just not how we operate. We know that the value is there, but we're also smart enough to look 5 to 7 years in the future. LIHTC comes off, insurance policy will continue to go down. We have a renovated building now that's in a really good condition for when it goes to market rate. Like, all of the signs are there that, hey, this is a good step, even though it's not the result that we're looking for. This is a step towards achieving that result. And it might look a little bit different, but the result is still there.
Yeah, and that's where keeping that long-term view. No, it was not a complete burn down. That's where that kind of long-term view really comes into it, guys. Is like, hey, listen, it's not ideal in the moment, but we've done the hard work. We've done the hard work. In fact, the work that we thought we were going to have to do 3 years from now when LIHTC comes off to get it ready for market, it's done. Like, now it is done. We just need to get there. Right. So guys, it's not going to look the same that we thought it was going to look, but the end result's still going to be pretty damn good. Right. So we've done the hard work. Let's secure this thing. Let's stabilize it. And then let's put ourselves in the position to get down the road where the payday is. Right.
Yeah. What do we pay for that place? I think, divided by, what do we have? 48 units there? 52?
48.
So we paid 72 a door. If we included what we spent in renovations, we would be at over almost $110,000 a door, including all the renovations and everything that we have into the property. We're not there though, because we have the insurance proceeds, that covered a lot of the damages that we repaired and things like that. But what are properties selling for in that market that are market rate now? Like low hundreds anyways?
Yeah, 100 to 110 a door. I mean, you've seen some of the guys going out there trying to get 130 a door in that market.
Yeah, when they sit on the market. But so it's like, okay, well, now we have a basis of $72,000 a door. We've done all the renovations to bring it up to $100,000 valuation, and now we just got to sit on it and wait for that LIHTC to come off, and hopefully the market is at 125 or 130 a door 5 years from now or 6 years from now. Who knows?
Yeah. So. But anyway, guys, like, it's you're never going to learn, and I'm kind of stumbling here, but you never learn like the walk away without going through some deals where you're like, I should have walked away. Right. Like, and here's the beautiful thing. Like Tim and I put under contract a couple of deals last year that I think 2 years before that, we probably would have tried to convince ourselves to continue forward with, right? Like we probably have been like, no, we can do this. We can make this work.
And we lost a lot of money through acquisition costs that we spent. I mean, we must have spent $60,000, $75,000 in acquisition stuff, inspections and deposits and all that stuff that we didn't get back.
Yeah. But remember the conversation you and I kind of had? I think it was like into October, 1st of November. We were both like, I'm really glad we didn't move forward with that deal. Like,
yep. We wouldn't have had the capacity with everything else going on.
No. Yeah. And guys, like, that's where you start to, create some, expertise and experience and stuff like that for yourself. And it's not that we entered all of this without any experience. We both had experience in real estate and doing property and stuff like that. It's just like, we're learning new things as we go. And, guys, you're going to do that. I would argue that anybody that be in this for 20 years, you're still going to be learning something. You're still going to hit a situation that you never hit before. Right.
Right. I mean, and we've even had some other stuff hit our desks recently. And I literally had, what was it? This was over the weekend, maybe, or even yesterday. I can't remember, but it was like, could we make money on this deal? Absolutely. Yeah. Is it really where we want to put our time and effort? Nope. Probably not. Let's keep looking. Right. And that famous saying or whatever it is, it's like, the more times you say no, the more successful you'll be. Is in that moment right there where we said no to something opened us up to a better opportunity in the future, even though we could have secured something right now. Right. Yeah. And it's just, you have to be willing to say no and walk away and be patient and wait for the right deal, where you can perform, where the metrics are going to work out, where you can raise the money, or if you can buy it yourself, or whatever you want to do in that regard. But that staying power to say no when everyone else is saying yes and things are hot, that comes with time. Ultimately, really comes with time and experience. So, all right, that's all we got for this week. This was a fun one. We had quite a number of people in the comments today, so appreciate everybody in the comments posting. And we will see you again next week. Peace.
See you guys.